Hello everyone, welcome to the 182nd episode of me learning how to trade in Forex. So in the last episode we went through how to buy an option on the IG platform. So when you buy options with IG, you're speculating on the price of the option, where the price is the premium. So can't exercise an option with IG, instead you can close your deal at any point against the current price IG is making for that option. Alternatively, you can leave the option to expire and your position will be settled against the value defined by the price of the underlying asset at the expiry point. And then we went through how it works in practice, so the examples and steps you need to take, and it gives you like an explanation of the interface. So when buying an option, the total cost is equal to the premium paid. A spread, which is the difference between the bid and ask prices, is incorporated into the premium. Final profit loss is calculated the following way. So profit loss equals size times the option closing price minus the option opening price. So keep in mind that your loss is limited to your premium though, even if above the calculation gives you a higher figure. So this is when you buy an option, remember, not when you sell the option. So closing your position and taking a profit, you can choose to close your deal at any point against the current price or leave the option to expire. At expiry, your position will be settled against the value of the option as defined by the price of the underlying at the expiry point. Maximum risk, so when buying an option, maximum risk is equal to the premium paid. So this is calculated as the trade size times by the price. So buying options is limited risk with a potentially uncapped maximum profit. And then we went through the lesson summary. So now we're on to selling options, some examples. So selling options, how do I write it? Buying options, some examples. So date is the 30th. So, selling options, both calls and puts, may be a little more challenging to understand than buying, but can be useful for flexibility and particularly in hedging. Selling call, also known as making a short call or written call, can generate profit when a long call, buying an option, will result in making a loss and vice versa. Selling calls and puts options can be useful for flexibility and in hedging, right? So selling a call, also known as making a short call or written call, can generate profit when a long call, buying option, results in making a loss and vice versa. So selling a call option, also known as making a short call or written call, can generate profit when a long call, which is buying an option, would result in making a loss and vice versa. Would result in making a loss. The reason is that options are decaying assets. Their value decays with the passage of time and they expire. So options are a decaying asset as their value decays with time and they expire. This timed decay works in your favor if you're an option seller. So the time decay works in your favor if you're an options seller. That's because the less time until expiry, so the closer you are to expiry, the less chances of the option has to go in the money. The option price becomes less valuable to the holder each day, benefiting the option seller. The option price becomes less valuable to the holder each day. The less time till expiry, the less chance the option has to go in the money. The option price becomes less valuable to the holder each day. The option price becomes less valuable to the holder each day. The option price becomes less valuable to the holder each day, which benefits the option seller. So which benefits the option seller. A short call option can therefore create a limited profit in a short time. So short call option is when you're hoping a call is when you hope the price is going to go down, right? Where is it? Call. Call gives you the right but no obligation to buy an asset. You take a long position when buying a call option, so you're hoping it's going to rise when you do call, right? So when you're short a call, so you're selling the options contract in the hopes that the underlying asset price is going to rise. But then why would you sell it? Selling an options contract in the hope it's going to rise. Can generate when a long was result in making a loss. So you're not really hoping it's going to go up, right? You know that it's going to drop instead. So you sell the call option when So the call option is buying the option hoping it's going to rise, increase in price. But since you know that buying the underlying asset won't necessarily make you the profit because you know some other factors is going to affect it, so it's not going to rise, you short it instead, which means you sell it at a higher price right now and then you can buy it back later at a lower price, right? So you're selling the option, so selling the underlying asset at the current price and then hoping to buy it back at a lower price later. The option seller makes a profit as long as the underlying price is below the strike price plus the premium collected. The option seller makes a profit as long, is this for both the calls and the puts then? A short call, no. So only for the calls. The option seller makes a profit as long as the underlying price is below the strike price plus the premium. The option buyer can profit only if the underlying price goes above the strike price plus the premium paid. We have our graph here. Let's go with red. So let's just say this is the current underlying market price, and then we got shorting a call option. How does that work? Shorting a call option. So because D has less time, the less the short call option, therefore. So strike price, underlying price, strike price. So would the strike price for shorting a call option be above or below? Call option will be above, right? So call option will be here. So this is your strike. Your premium would be on top of this. So this bit will be your strike plus your premium. Okay, so purple on this. So you're shorting this. So you're shorting a call option. A call. Oh wait, there's a bit more. I'm going to read this on because I can't get my head around it. So the option buyer can only profit. The option makes a profit if the underlying price is below the. If the underlying price goes above, is above the strike price plus premium. Okay, so option buyer only makes a profit if the underlying price is above the strike price plus the premium. Yeah, so this is their so anything above. Whoa, can't even see that. Let's go black. Anything above this one is the option buyer's profit margin, profit bit. Option seller makes a profit as long as the underlying price is below the strike price of premium. So anything below this bit is the seller's profit. So you could think of this shorting a call option as doing what the opposite of buying a call option is. So it's just basically, because buying a call option is anything, your profit level only starts to come in when the underlying market price goes above the strike price plus the premium. So if you're shorting it, then it's basically the opposite. So anything below the strike plus the premium is the profit levels for shorting a call option. And the explanation, so when you buy a call option, you're hoping the market goes above your strike price and the premium, so you can buy it at a cheaper rate than what the underlying market price is. So that's basically a profit right there, because then you can sell it back at a higher price. Right, okay. Buy it cheaper than the current market price. That's when you buy a call option. And the reason you would short a call option is so that, since you know that the market isn't going to rise above the strike price plus the premium, you're going to short it so that you could sell it at a higher price than the underlying market price. Yeah, so say the current market price was this red one at the expiry or whatever. Because you've shorted the call option. No, say if the. Well, I just confused myself there. How did I say it last time? Read on. Selling a call. So this is a strategy that you might use if you were to bearish about the prospects of the underlying market. You thought it would fall, or you thought the price was likely to stay the same. Yeah, so it would fall. So hoping it goes lower so that you can sell it for a much higher price than what the current underlying market is offering you. Selling a call option. Sell a call option if you were bearish about the prospects of the underlying market, so you think it would fall. Or if you thought the price was likely to stay the same. The profit loss profile of a sold call is a mirror image of the profit of a long call. Let's take another example using the FTSE 100 with a strike price of 6,500 and a 35-point premium. And look at the value of the sold call for different levels of expiry. Let's do this like that. So that is 6500 and a 35-point premium. And look at the value of the sold call for different levels of expiry. If the underlying market is above the break-even point of 6535 expiry, so since the premium is 35 points, then that's 6535 for a sold of the sold call for different levels of expiry. If the underlying market is below the break-even point 6535 expiry, so anything in this area, you lose overall on the trade. If it expires 6500 or below, you'll make a profit equal to the premium. Hey, whoa. That's wrong. Hold up. So anything is above the break-even point. Oh, right. So anything above here is loss. So that's L right here. And then anything 6500. So anything above here, that's a profit. And this bit, I'm assuming, still you still make a loss there because you won't have enough. You won't be able to make enough to cover the premium which you have to pay. So this is selling a call option. So if it goes up, but what happens to the premium? Oh no, since it's a call option, you're basically going long on it. If the underlying market is above, you'll lose the overall trade. If it expires 65, you'll make a profit equals to the premium. Risk. Selling or writing a call option is a risky strategy. Your potential risk is unlimited, as the underlying price could theoretically increase to infinity. If the market rises rapidly, you could suddenly find yourself with runaway, uncapped losses on your hand. Reward. The maximum possible reward for writing an option is a premium. In our example, the seller of the call will make a 35 points provided the FTSE expires at 6500 or lower. Carefully used, this means that a sell could offer a good prospect for profit. So the maximum profit you can get is the premium, which is 35 points. It's still so confusing. No wait, so actually, when you buy a call option, anything above here is your profit, isn't it? and anything below here is your loss. So selling a call option is just basically the opposite. So anything above here is your loss, anything below that is your profit. I think that's just the way you have to understand it. I can't like find out a reason why, or I just can't explain it properly. Selling a call option can have unlimited risk as the underlying price could theoretically increase forever. The profit loss profile of a sell call option is the mirror image of a buy call option. Reward: the maximum possible profit for writing an option is the premium. So the maximum possible profit for writing an option is the premium. In our example, the seller of the call will make 35 points provided the FTSE expires at 6500 or lower. Carefully used, this means that the sell could offer a good prospect for profit. And you only make the premium because that's what the buyer pays to the seller, isn't it? Because the buyer has to pay the premium regardless of whether he goes through with the option or not. So that's the only amount of profit you can make as a seller when selling a call option. Selling a put, so sell a put option if you were bullish about the prospects of the underlying market, so you think it would rise, or if you thought the price was likely to stay the same. So neutral to bullish outlook for a particular market, so you thought the price was likely to stay the same or rise. The profit loss of profile for selling a put exactly the opposite of the profit loss profile for buying a put. Let's look at this, the FTSE option with a strike price of 6150 and a 50-point premium. So the profit loss profile of a sell puts option is the mirror image of a buy puts option. So strike price is 6150 and a 50-point premium. If the FTSE is at or above 6100 on expiry, you'll make a profit. If not, you'll make a loss. Your maximum profit will be achieved if the FTSE is over or at 6150 on expiry. So your maximum profit again is a premium. So a maximum profit sellers can make is a premium, that's it. If the FTSE, you make a profit, if not you make a loss. So your risk, selling a put option involves substantial risk, although your potential loss isn't completely limited as it is when you sell a call option. As the market price drops, the value of the put for the holder increases, which isn't so good for the seller. Worst case scenario occurs if the underlying asset drops to zero. This will give you a loss equal to the strike price minus the premium. If the market the value of the put option increases, which isn't good for the seller. Put option for the holder, for the buyer, basically for the buyer, increases, which isn't good for the seller. The worst case scenario is if the underlying asset drops to 0, which would give you a loss equal to the strike price minus the premium. Reward. The maximum reward is a premium, so yep. The maximum possible profit for writing a put option is the premium. Writing a call option is a premium. Yep. No option example, as long as the FTSE stays at 6150 or higher, as the option seller or writer, you'll make all 35 points of premium. So basic strategy: sell call, sell put, risk maximum loss, unlimited, high but the underlying price cannot fall below 0, reward limited to premium, limited to premium. See, this is so we're comparing selling and buying call and put options. Risk limited to premium, unlimited, high, but the underlying price cannot fall to 0. And your reward is limited to premium, unlimited, almost unlimited. So buying options is looks like way better deal than selling options though. So your risk and rewards is pretty much the opposite when you're buying and selling the option. Make sure you understand the risk and reward for selling an option by answering the following questions. What strategy could you use if you thought the price of gold, was likely to stay in the same or to rise? Say the same or rise. So sell a put. If gold maintained its value or rose, the buyer wouldn't exercise the option and you keep the premium as a profit. Here we go. So if the value does rise, the buyer wouldn't exercise the option because they're putting an option. They're doing a put option, so they're hoping the price is going to drop instead. So if it rises, confusing myself again. Short position when putting an option. Yep, short position. So the buyer is shorting. So the buyer is obviously buying a short option. No, the buyer is buying a put option. So they're hoping the price of gold is gonna drop. So you sell a put option to them in the hopes that the gold doesn't drop, or likely stay the same, or rise. So if the gold doesn't drop, or it maintained its value, if the gold doesn't drop or increased, the buyer wouldn't exercise the option because they're hoping for it to drop so that they can exercise the option to buy it at a lower price than the market price. But since it hasn't done that, they won't exercise the option because there's no point buying gold at a lower price. There's no point selling gold at a lower price than the current market price. I think I've just confused myself. Did I even say the right thing the first time? Because I thought I said buying like that. So current price is here. Buyer buys a put option, so they're hoping, so their strike price is about here, so they're hoping the market's gonna drop below to whatever, like here, so they can sell it at a higher price over here, right? But if gold maintained its value or rose, so if the say gold maintained its value and kept on going at this level here, then there's no point of them exercising the option, which is selling the gold at this price when they could sell the gold at a higher price over here. So if they don't exercise the option, they gotta pay the premium to you. So you'll make a profit, which is the premium. Okay, question 2. Which has a higher risk? Selling a put, selling a call? It's selling a call option, isn't it? Because the underlying value of the asset could rise to infinity. So your profit, so your loss is technically unlimited. Selling a call can mean in theory that your losses are unlimited, since there's no knowing how high the underlying market could climb. If you sell a put, your loss will be capped if the underlying market falls to zero. Yeah. Okay, lesson summary then. Selling a option or selling an option can generate a profit in situations where buying an option will result in a loss, and vice versa. And vice versa. Selling is also known as making a short call or put or writing an option. Selling options is a strategy focusing on the fact that options are a decaying asset. This time decay works in your favor if you are an option seller. You could because the option price becomes less valuable to the holder each day, which benefits the option seller to the buyer here. Each day so you could choose to sell a put option if you believe the price of an asset would stay same or rise. You could choose to sell a call option if you believe the price of an asset will stay the same or. If you sell a put, your risk is substantial but capped, whereas selling a call exposes you to unlimited risk. Cool. So how to sell an option in the IG platform then? So how to sell an option in the IG platform. As for bought options, when you sell options with IG, we don't actually sell assets on your behalf. You are speculating on the price of the option where the price is the premium. As for bought options, when you sell options with IG, we don't actually sell the assets on your behalf. You're speculating on where the price is the premium. Okay, so we'll settle your positions against the value of the option based on the settlement price of the underlying asset at the expiry point. We'll settle your positions against the value of the option based on the settlement price of the underlying asset at the expiry point. This could mean an additional loss for you if the option doesn't work out as you predicted. If the option expires worthless, you get to keep all the premium. Let's see how this works in practice. But that has to wait until the next lesson. So I'm going to leave this episode here then. Yeah, that selling options. Whew, my mind. Whew. So yeah, I'll leave this until the next video. So in the next video then, I'm going to carry on with how to sell an option in the IG platform. So thank you all guys for watching. See you guys in the next video. Laters.